from a net standpoint, I've seen it, I've been doing this over 15 years. I've seen it where in a lot of cases, the losses at the front end of the investment will offset most of the gains on the back end.
Hey, everybody, welcome back to another episode of the Richer Geek Podcast. Today, we have Adam Bergman. He's a 9-time author, former tax and, I'm going to get this wrong, ERISA attorney, and the founder of IRA Financial, an industry level and self-directed retirement solutions. As a founder of IRA Financial, he's helped over 25,000 clients take control over their retirement funds and invest over $4.6 billion into alternative assets, including real estate, crypto, gold, private businesses, etc. How you doing, Adam?
Great. Thanks so much for having me, Mike. Awesome.
Absolutely. So, give us the short version of who you are and how you got in this business. I don't need to know where you went to kindergarten and all that sort of stuff, but who is Adam?
Oh, it's actually, it's a super interesting story. So I was a tax lawyer in New York City for about 8 years at some of the largest law firms in the world. I have a master's in tax law, and I had never, ever, ever heard of a self-directed IRA. I just thought you were only allowed to buy stocks with your retirement account. So I was lucky enough. I had a client who was a big hedge fund client in New York, and the partner asked me to look at whether he could use his IRA to invest in his hedge fund. And I was just blown away by this industry. I could not believe that you were able to do it. And my thinking was, hey, if I'm a pretty smart guy, I have a tax degree, a master's in tax law, I worked at some of the largest law firms in the world. If I never heard of this stuff, then there must be millions and millions and millions of Americans out there that would love to tax efficiently use their retirement funds to invest in alternative assets. If they just were educated and knew it was an option, they would at least have the freedom to make that decision.
Yeah. So let's get into self-directed IRA. Everybody knows what their IRA is. It's it takes some, out of my paycheck every month, but self-directed, what does that mean? That means I can just grab it myself and do what I want, but how does it work?
Okay, so it's a great question. When IRAs were created in 1974 by ERISA, the Congress, the IRS, the tax code did not distinguish between IRAs that invested in stocks and IRAs that did non-traditional investments. Okay, so there's only 3 things you can't do in an IRA. That's it.
Okay.
Under Section 408, you can't buy life insurance, can't buy collectibles like artwork. And then thirdly, under Internal Revenue Code Section 4975C, you can't do any transaction that in any way directly or indirectly personally benefits you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities 50% controlled by such persons. So that means you can't buy a house and live in it, right? You can't take your IRA, take your family to Disney, take your IRA, buy yourself a Rolex watch. Otherwise, you can do it, whether it's private equity, hedge funds, real estate, hard money loans, gold, Bitcoin, so on and so forth. As long as you don't violate those 3 categories of investments, you can do it. So there's really no distinction between an IRA you invest in TD or Schwab or Fidelity or Vanguard, or a self-directed at IRA Financial. The only difference is we unlock your retirement account. We don't make money selling stocks. So we allow you to invest in anything allowed by the IRS. We are an open architecture platform. You have the freedom to make those investments. We don't sell products. All we do is we get paid a flat fee for administering and custodying your IRA. That's it.
And it is true that you have to use a custodian. You can't touch the money, right? Just like I can't, a lot of people say, well, can I just put it in my checking account and then wait, and then I'm just going to invest it in whatever I want when I see it. You have to use a custodian, correct?
Great question. So yes, by law, 3 types of institutions can be a custodian: a bank, a financial institution, or a state chartered trust company like IRA Financial. So like Walmart can't be an IRA custodian unless they get a charter to do so. So that means if you have your money in an IRA at Fidelity and you want to buy real estate, if you just pulled it out of Fidelity, after 60 days, that would be a taxable distribution. And if you were under 59.5, there would also be a 10% additional tax. So What you have to do is you have to move the money tax-free from Fidelity, which is a custodian, it's a financial institution, to a true self-directed custodian like IRA Financial Trust. It's a tax-free transfer. And then from IRA Financial Trust, we will then initiate your investment into real estate or private equity or Bitcoin or so on and so forth. So yes, you're right. You need that custodian as a bridge to make the investment, because without that bridge, after 60 days, it becomes a taxable event.
And each distribution, let's say that, ladies and gentlemen, all of you know that I do hotel syndications. One of my clients use Adam, one of my potential investors. They invest in one of the hotels. I give out distributions. 100% of that has to stay in that IRA, correct?
That is correct, because the IRA is the owner. Just like if Adam
Yeah.
owns 100% of a restaurant and there's a distribution from the restaurant, it would go to Adam, the owner. So in the case of your hotel syndication, everything I assume goes pro rata. So if my IRA owned 1% of the hotel and there was $1 million of net distribution funds available, my IRA would get 1% of those funds. And generally, in most cases, they would be tax-free.
Okay. So let's talk about, is it good? Because I've heard some rumors, some things people say like, oh, no, there's this taxable on those distributions. And, there's something in there that they said that you should not do self-directed IRAs because they're still taxed, even though they're not touching it.
Well, yeah, they're partly wrong. So
Okay.
here's the truth. As a tax attorney, this is the law. So in 95% of the cases, when you make an investment with your IRA, it will return back to your IRA tax-free. That's known as deferral. It's known as compounding returns. If you have a Roth IRA, so long as you're over 59 and a half and the Roth's been open 5 years, you can then pull the money out of the Roth IRA and live off those funds tax-free. But let's stay in the IRA world. So if your IRA generates capital gains, interest, dividends, royalties, or rental income, the funds will come back to the IRA tax-free. Okay, no tax. So if Adam invested $50 in Bitcoin and it went up to $50 million and I bought it in my IRA, when I sold the Bitcoin for $50 million, it would go back to my IRA tax-free. It's a capital gains transaction. So it's just like if I got dividends from a stock, interest from a hard money loan, or if I bought and sold real estate. Now, there's this ugly 4-letter word called UBIT, unrelated business income tax, okay, which is what you were essentially referring to in your comment. So UBIT only attacks a very, very minuscule amount of retirement transactions. And it's only in these 3 specific cases. One, if you use margin to buy stock. So if you use it has to be a non-recourse, because you're not allowed to personally guarantee your IRA's obligation, unfortunately. That's just a rule in the tax code. So if you use margin to buy stock and you made money, there potentially could be a UBIT tax. And the tax rate follows the trust tax rates, which are relatively high. They can go all the way up to 37% if you have about $15,000 in net income. But if your investment generates less than $1,000 or has losses, obviously there's no tax, and the losses could be used to offset future income. So that's the first way to trigger UBIT. The second is if you use non-recourse loan to buy real estate. Okay, I have $50,000 in my IRA. I borrow $50,000 from a bank, non-recourse, meaning I don't personally guarantee it. So I have 100 grand, I buy a piece of property, I sell it for 200, 50% of my gain, which relates to the debt to equity ratio, 50 and 50, would be subject to this UBIT tax. There's a workaround there. I can set you up with a 401k if you're self-employed, and there's an exception from UBIT on real estate in a 401k. And then the third and most common way to trigger UBIT is if you invest a retirement account in an IRA or 401k in an active business, like a hotel, like a restaurant, like a software company, and that venture is in an LLC or a pass-through entity, there could be UBIT on the business income, right? So that's your point. Let's say you have a restaurant and your IRA owns 50% of it and it generates $100,000 in net profits. My IRA potentially could pay tax on that 50% of the allocation. Now, there are ways to limit it. I can set you up with a C Corp blocker, and I can reduce 37% to 21%. More sophisticated funds use offshore feeders, which can get you around the UBIT depending on the investment. I can restructure the investment in different ways, which this is what we do with our clients who are trying to do more sophisticated investments that could trigger UBIT. We would get into a scenario with them and on a case-by-case basis, work out a structure that minimizes tax. But to answer your question, going full circle, sorry to be so
it's okay.
long-winded, that's what lawyers do. In most cases, there's no tax, okay? It's generally, if you use real estate with leverage,
Yep.
in an IRA, or if you invest in an active trader business in a pass-through entity like an LLC. That's why if your IRA owns Apple stock or Tesla or Alphabet, there's no UBIT, right? Because though 99% of all publicly traded stocks, if not almost 100% now, are C Corps. A C Corp blocks the UBIT, right? Why? Because a C Corp pays 21% entity tax. So there's no reason to have a UBIT tax. It's only imposed on a pass-through LLC where LLCs do not have an entity level tax, right? There's only a member shareholder level. So that's why this ugly 4-letter word tax comes in. The good news is there's ways to get around it and there's ways to minimize it if you work with the right people.
Well, there you go. Because now I know, because I've had some investors say, no, there's that UBIT thing. And I'm like going, I'm a hotel guy. I'm not the attorney. I mean, I don't know. So thank you for
we know
that. Now, you did say invest in a hotel that has leverage. What if I'm buying a hotel for cash and there's someone that has a self-directed IRA? There's no leverage.
So, right, because there's no leverage, that's great, but you still have that business income because the IRS would treat a hotel unlike an apartment complex that's deemed rental real estate. Under the Treasury regulations, a hotel, because of the service provided to the hotel guests, it's treated as a business instead of a passive real estate rental income, which would be exempt from UBIT. So if instead of a hotel, let's say you invested in an apartment complex, that would be, and no leverage, there's no tax on any rental income or capital gains on the sale. But a hotel, because of the level of service provided, the IRS treats that as a business. So there would potentially be UBIT tax on distributions, even if there's no leverage in the United States. There's potentially workarounds offshore. But again, I can set you up with a C Corp blocker. I can reduce the tax to 21%. Also for real estate and hotel operations, because of accelerated depreciation and a lot of losses in the first several years of the investment, those losses could be used to offset future income. So from a net standpoint, I've seen it, I've been doing this over 15 years. I've seen it where in a lot of cases, the losses at the front end of the investment will offset most of the gains on the back end.
Okay, there we go, ladies and gentlemen. Again, Adam Bergman, he's talking everything self-directed IRAs, and we're going to continue down those lanes. So can I roll over any other type of retirement accounts? Let's say that, I've got some in the IRA, but I don't have a lot, but I've got all these other different things. Can I shift different funds around into a self-directed IRA or does it always have to be an IRA that gets self-directed?
Yeah, so another great question. So this is how you can fund a self-directed IRA. Number one, contributions. 2025, you can still actually do, if you're listening to this podcast or watching this before April 15th, 25, you can still do this you can still make $7,000 contributions for 24 in 25. If you passed April 15, 25, then you can still do $7,000 or $8,000 if you're over 50 for the 25 year. So that's the first way to fund an IRA is you can always make contributions. Yep. If you make too much income, you may have limitation on how much you can deduct, but you can also always do a Roth IRA through what's called a backdoor Roth IRA. Even if you make more than $240,000 a year, you could still potentially do a Roth. So that's always an option. Number two, rollover or transfer. So if you have an IRA at Vanguard or Fidelity or traditional IRA or a Roth IRA, you can always move that to IRA Financial if you want to do alternative assets tax-free. If you have a 401k at work, okay, do you have access to those funds? So here's the interesting thing with 401ks, which a lot of people don't realize. It's actually not your money until you leave the job or you turn 59 and a half. So if you are, let's say, work at Tesla or Apple, and you're 45 years old, you have $1 million in your 401k, unless you leave your job, that money has to stay in the 401k. You cannot roll it to a self-directed IRA or even any IRA because there's a plan trigger and event rule. IRAs don't have trigger and event rules. So if you leave your job at Apple because you want to go work at Google, you have a trigger and event rule, and then you can now move the funds tax-free in a rollover from your employer 401k to an IRA, just the same way if you reach the age of 59 and a half. So the only way to use non-retirement money in an IRA is through a contribution. So if you have $1 billion in a bank account somewhere, and you want to open a self-directed IRA, and unfortunately you just never had time to save, unfortunately all you can put in is $7,000 or $8,000 if you're over 50. But if you have other retirement accounts like a 401k, even a 457b, a 403b, government plans, SEP IRA, simple IRA, Roth IRA, you could then roll those into a self-directed IRA to do investing. We also do health savings accounts that could be self-directed, or Coverdales, not 529 plans, but Coverdales for education. Those could also be invested in alternative assets.
Now, see, everybody, I don't know, my head starts going, and that's why we leave it to the experts and why we don't do this ourselves with Adam. So, there's all these lawyers, attorneys, especially the government, they love these acronyms, synonyms, and all the other M's. And, we talked about UBIT. Then there's UBTI, and then there's UDFI. UDFI, the same thing. It's all just different words of saying the same thing.
Yeah, so unrelated business income taxes, UBIT, UBTI is unrelated business taxable income, same thing, okay? And then UDFI is unrelated debt finance income, which triggers a UBTI. So to keep things simple, just remember, if you do these three things, if you invest in an IRA that uses leverage to buy stock, uses an IRA to leverage to buy real estate, there's an exception for 401ks, or use an IRA or 401k to invest in a business through a pass-through like an LLC, you could trigger UBIT. Whether you call it UDFI, UBIT, UBTI, it's the same 37% maximum tax.
Yeah.
So
okay, there you go. Just want to get that out of here because you start getting into and it's whatever. Now let's get into something else. Some people will talk about checkbook IRAs. So if I have a self-directed, do I get a checkbook, or what is a checkbook IRA, or an IRA LLC type of a thing?
Yeah, so great. I love the question. I was one of the first companies to work in the self-directed IRA LLC space. I've actually written 2 books just on the IRA LLC. So there's 2 ways you can use a self-directed IRA. There's what's called the full service or custodian approach. And here's an example, right? Adam has $100,000 at Fidelity, and I want to buy a piece of raw land. Okay, Fidelity is not going to let me buy the raw land. I open an account at IRA Financial. I roll the $100,000 tax-free from Fidelity to IRA Financial. And then I tell IRA Financial, hey, IRA Financial, invest my $100,000 in that raw piece of land. And then title to the land would be IRA Financial Trust Company for the benefit of Adam Bergman's IRA. And that's a full service or custodian IRA. That's probably the most popular. Over the last 10 or so years, the whole concept of a checkbook control LLC has become more popular for a number of reasons. Number one, people want an LLC because they want limited liability protection, especially if they're doing real estate. Number two, they want privacy. Some folks don't want people to know they're using an IRA to make an investment. So what they do is, instead of having the IRA Financial custodian buy the land, IRA Financial will set up an LLC, a special purpose LLC, call it whatever you want, XYZ LLC, so long as the name is available. We'll generally set it up in the state you want, but most people will set it up where the asset will be located, the real estate, for example, and we'll provide you the EIN, the operating agreement. And the checkbook control comes from, because you as the manager, the IRA will be the owner, you'll manage it, right? Giving you what's called checkbook control. So you can send a wire, you can write a check, you can do a Venmo or whatever. If you need to pay a contractor, right? You need to pay a plumber, you pay a landscaper, you got to pay taxes, you got to hire an accountant, lawyer, whatever. It's much easier to do it as the manager of the LLC, because you can write the check versus going on my app, going to IRA Financial, indicating where you want us to send $1,000 to pay Joe the plumber. And it takes more time and more friction, more complexity for no reason. You can get the LLC, you have more control, you have the privacy, and you have the checkbook control, LLC limited liability protection. So for a lot of real estate investors and investors that want more privacy, it's a small price to pay. It's a small one-time establishment fee, and that's it. It's the same fee going forward. For other folks who are just like, hey, I'm investing in a private equity fund. I don't care if people know it's an IRA that owns it or I'm buying a raw piece of land. There's not a lot of activity. I don't need to involve the custodian very much. I don't need to spend the money up front. I don't care about limited liability protection. It's cool. There's no right or wrong. Both are
Yep.
great solutions. It's what works for you.
Yeah, that's a very good explanation, everybody. Again, Adam Bergman. It now, is there a minimum? Some people say, well, maybe I don't have enough, to cover fees, cover, what are you seeing? Is there a minimum? It's like, hey, unless you have 50,000 and you're self-directed, don't do things. What would you probably tell people?
You know what? With cryptos, it's different, right? We've opened a lot of accounts lately where people put in $2,000, $1,000
Hmm.
because our crypto account is basically like $100 a year. It's cheap, and there's no other than that. There's really no costs. But yeah, generally, as you know, doing private equity, there's not a lot to buy for less than like $25,000.
Yeah.
So most of our clients will have more than 25K. Um, but with crypto has been the one asset class that has expanded the client base because there are people that just want to get exposure to some coins and they'll put $1,000, 2,000, 3,000. But for more of our traditional alternative asset investors that are doing private equity, real estate, gold, people will get in for 10,000 plus
Mhm.
generally. We have flat fees. It's about $400 a year, so it's not super expensive
Yeah.
to maintain the account. We don't charge asset valuation fees, so as your
Mm.
investments and account goes up in value, you don't have to pay us more. But I would say generally, yeah, the 25,000 plus is kind of the sweet spot where we see most of our clients.
Yeah. And that is very important, ladies and gentlemen, is the valuation fees. And that's thing, it's like, man, I just paid one of those. No, and if I had gone
Yeah,
with
it's not
Adam, I
fair.
wouldn't have had to pay that. So
Yeah.
it's you live and learn.
Think about it. Like, why should you, right? Because you're doing the work. It's self-directed, right? Why
I
should
know
I
I'm
make
filling
money?
out the
Because you're
form.
smart.
I'm
You're
filling
smarter than
out the
me. Why
form.
should you make? Yeah, exactly. You're filling out the form. You're doing all the work. Why should I make more money? Because you are smart. I get it if you're a financial advisor and you're telling me, hey, buy this fund A versus fund B, fine.
Yeah,
But no, I don't believe that. We keep our fees low. And we want people to have the freedom to invest in what they want.
that's right. So how about those people? Couple last questions. Those people just like, no, I don't do the self-directed. It's probably because they don't know anything about it, but I have a solo 401k. Should I
Mhm.
use that?
Yeah.
And what are the differences between those two?
Solo 401ks are great. I wrote two books on those. Great
Mm.
plan. It's basically a mini 401k for someone who's self-employed. So if you have a business, if you're self-employed, you have a business with no full-time employees, that means 1,000 hours or more, or 2 consecutive years of 500 hours or more. Spouses don't count as employees, so you and your
Mhm.
spouse can still open a solo K.
Mhm.
You can set up your own little mini solo K, which is great because you can be the trustee. And our plan, unlike Fidelity or Vanguard, has checkbook control, giving you as the trustee the ability to make alternative asset investments without an LLC. You don't even need it because you're the trustee. You
Yeah,
can put away a lot more money than an IRA, 70,000 plus in 25.
yeah,
You can borrow up to $50,000 against your money tax free. You can do what's something called a mega backdoor Roth, where you can put away $70,000 dollar for dollar all in
yes,
Roth. You got great asset and credit protection. And if you want to buy real estate and use a non-recourse loan for leverage, you don't pay that UBIT tax because there's an exception under 514C9 of the code against UBIT for 401ks. So for my real estate investors, I try to get them all into solo Ks if they're
hmm
self-employed and they satisfy those rules because they love the exemption from UBIT and the flexibility. So it's kind of an IRA. It's just a more robust IRA because you have more features, but it gives you the same alternative asset powers as a self-directed IRA.
yeah, and it's so true. And ladies and gentlemen, if you have your own business, like I do, and I don't know how many decades I went not doing any of this stuff. I just put money in a savings account that gave me 0.00002%. And it wasn't until I had, got a CFO that said, Mike, I can save you $180,000 just this year by opening this and this and backdoor this and all these different things. And And I was like, oh my goodness, man. It's like, okay, well, better late than never, I guess. But ladies and gentlemen, if you are self-employed, and I know a lot of you are, think about this stuff, because will set you up on these things, and you won't believe it doesn't cost that much to set these things up, but just
Oh,
the tax savings. Instead of me giving myself all these salaries, I could be putting all this money away in tax deferred accounts, and it was just absolutely amazing. And again, everybody, it's Adam Bergman, IRAFinancial.com. Now, Adam, when we click on IRAFinancial.com, and I know some of our listeners will, what will they find? How can they get some educational materials?
yeah.
What's on the website?
Yeah, so you can go to IRA Financial, IRAFinancialGroup.com, IRAFinancialTrust.com. Like there's lots of stuff. I've written 9 books. You can look for them, on Amazon, you can go on YouTube. There's just lots of information. I would just make sure you know who you're getting it from, because unfortunately there's a lot of these so-called experts online, but this is
Mhm.
a tax area. Just like I don't pull my own teeth. I'm not a dentist. Like I went to
Right.
law school, I have a master's in tax law, and unfortunately I deal with a lot of clients that get bad advice and they come to me and they never are spoken to about UBIT or other
Mhm.
issues, prohibited transactions, and they get into jams.
Yeah.
So make sure you look who's providing the info, speak to the right people. You can do a lot on your own. There's a lot of great data out there. And ultimately, like you see the American flag behind you, Mike, like there's nothing more American, I think, than taking control of your future.
Mhm.
There's no guarantee Social Security will be here. Forget
Mhm.
about 30 years. How about in like 8 to 10 years? It's
Yeah.
supposed to run out in the next, 7 years. Okay. So the government doesn't provide us, other than Social Security, we're on our own. So the way to do it is, whether it's an IRA, 401k, we have to educate ourselves, because unfortunately, our schools do not educate us
Mhm.
on retirement saving. Like obviously, I went to college, I went to law school, I have a master's in tax law. I never even knew about this stuff.
Yeah.
So we're failing ourselves. So unfortunately, it's up to you. And if you're listening to this, you're smart enough to realize that if you understand compounding returns and
Mhm.
you do these 3 things, I'll end with this 3 simple
Yep.
things. You start as early as you can, just make a contribution, whether it's an IRA or 401k. If you are at a job that gives you a 401k, put in as much as you can, because they're probably giving you at least a 3% safe harbor match. So it's
Mhm.
free money. Number 2, be consistent. Just try, even if you have a tough year, put $100 away, $50, 1,000. Just keep your habits. And third, just the easiest part, trust the process. Just wait. The compounding returns, the longer you let your money flow, the more it's going to grow. If you look at the S&P 500 the last 100 years, it's over 10%. You add alternative assets in there, you should be getting 13 to 16% on an annual basis. And we all could be 7-figure tax-free millionaires. We just need to take our time and be patient.
Yeah, there you go. And everybody, this is one of the reasons why I love having my podcast, why I created the Richer Geek, is to have Adam on, people like Adam, to give us the education, give us the knowledge so that we don't make those mistakes. So listen to this podcast. I know a lot of you are going to be taking notes. Go to his website. And Adam, where else can people find you?
Yeah, don't call me at 3 in the morning. No, I think, yeah,
Nice.
just IRA Financial, IRAFinancialGroup.com, IRAFinancial.com, IRA Financial Trust. You can just Google IRA Financial. There's so much info. You can Google self-directed IRAs. There's great videos. You can go to the
Mhm.
IRA Financial YouTube channel. There's a lot of great content. It's all free. And you can just play around, ask questions. That's the most important thing. Ask questions, be curious. This is how rich people get rich. I'm telling you.
Mhm.
Whether you can Google Peter Thiel if you want to learn.
Yeah.
He is the smartest investor. He's about $4 billion in a Roth IRA, tax free, meaning I think he's around 57. In 2 years, he'll be able to pull that money out tax free. And he's kind of a mentor. So there's opportunities, and I've seen it with my client base. I've seen people turn 5,000 into 10 million. I've seen people turn 500 grand into 6 million. It
Mhm.
happens. You obviously need to know what you're doing, but if you can do it and hit a home run, why not do it in a tax efficient account and shelter all the gains from taxation?
Absolutely. And that's why we trust professionals like Adam. Adam, thank you so much for coming on the Richer Geek. Have a wonderful night.
Thanks, Mike. Pleasure.